Welcome to this deep dive. The headlines right now are, well, they're loud.
Extremely loud.
Yeah, and the geopolitical picture is just incredibly volatile. But, as always on this deep dive, our job isn't to just react to the headlines. It's to look under the hood at the macroeconomic data.
Right.
Because we are looking at a massive, complex global event right now, the outbreak of the 2026 U.S.-Israel war with Iran. The U.S. has dubbed it Operation Epic Fury, and it officially began on February 28th, 2026.
And, we should state up front, the human element of the conflict is profound. It's a tragedy.
Yeah.
Today, however, our focus is strictly on synthesizing the market mechanics and the economic data.
Exactly.
We want you, the listener, to understand the structural forces at play.
Yeah.
So we're dissecting how global supply chains, energy markets, and institutional portfolios are responding in real time.
Yeah, and before we unpack the numbers, just a quick note on the nature of our sources today. We are pulling from reports that they contain some pretty politically charged content regarding the actions of various nations and leaders.
Which is unavoidable with a topic like this.
Right, completely unavoidable. So we want to be absolutely clear. We are not taking sides. We're not endorsing any political or military viewpoints, left or right. Our role is strictly to act as your guides, impartially conveying the ideas and data contained in the original source material.
Our mission is to cut through the noise. We're evaluating a stack of really comprehensive financial and geopolitical research. We've got Alliance, Oxford Economics, Berlin Capital Advisors, RBC Wealth Management, and BNY.
It's a heavy stack.
It really is. We also have targeted investing data on the SCHD Exchange Traded Fund, alongside overviews from Wikipedia and a really interesting academic analysis of the Tehran Stock Exchange.
Which we'll get into.
We will. We're going to map out the short-term and long-term economic impacts, analyze what the global economy looks like if the U.S. achieves its stated objectives, and break down exactly how financial markets are digesting this shock.
So let's just jump right in. On February 28th, the U.S. and Israel launched major combat operations. According to the sources, this included the assassination of Iran's supreme leader, Ali Khamenei.
A massive escalation.
Massive. Iran retaliated immediately, targeting U.S. and Israeli infrastructure, and the conflict just rapidly spread across the Middle East. But when we look at the transmission channel from military action to the global economy...
It all funnels down to one spot.
Exactly. A single geographic choke point. The Strait of Hormuz.
This narrow waterway between the Persian Gulf and the Gulf of Oman is, it's arguably the most critical artery in the entire global energy system.
Roughly 20% of the whole world's oil flows through that specific strait.
And what's fascinating here is that the initial market reaction we witnessed wasn't actually driven by a physical lack of oil being pumped out of the ground.
Right, the wells were still operating.
Exactly. The spike was driven entirely by maritime disruption and the complex world of shipping logistics.
And the shipping data from Allianz really illustrates that, doesn't it? They cracked over 200 oil and LNG, that's liquefied natural gas vessels, just sitting at anchor outside the strait.
Just parked.
Just parked there. And they stopped moving, not because the oil was gone, but because of war risk insurance.
Yes. Underwriters in London essentially paused coverage, or they spiked premiums so astronomically high that maritime companies instituted these precautionary pauses.
So the market was instantaneously repricing geopolitical escalation risk. Traders were reacting to the fear that the oil couldn't transit the strait. They were anticipating a supply crunch before it actually even materialized on the balance sheets.
And the numbers reflect a massive jolt of panic.
Yeah.
Brent crude oil spiked instantly. The models and reports vary slightly, but they show crude jumping from the low 70s up to $82.
With some predictive models warning of rapid spikes passing $110 a barrel.
Domestically, U.S. gas prices jumped 7.5% right out of the gate, hitting over $3.20 a gallon.
Goldman Sachs was issuing warnings it could hit 3.5 up or cross $4. And simultaneously, the VIX, the volatility index that just shot up 24%.
But that chaos bled well beyond the energy sector. Global aviation and supply chains faced immediate, severe bottlenecks.
Airspace closures cascaded across the UAE, Qatar, Kuwait, Syria, and Iraq. It grounded thousands of commercial and cargo flights.
The disruption to the gold supply chain is a perfect example of those bottlenecks.
Oh, the Dubai flights.
Yes. The sources point out that a massive amount of the global physical gold supply flies through Dubai. Because the airspace was closed and those flights were grounded, the price of gold in markets like India swung wildly.
From a discount to a massive premium in just a matter of days.
It just shows how sensitive, seemingly unrelated markets are to logistical airspace issues.
So to understand how the broader financial markets process this kind of sudden, severe political risk, that academic paper on the Tehran Stock Exchange provides a highly relevant framework. The researchers use something called the Markov switching approach to model investor behavior. And I want to dig into that because the Markov switching approach sounds like heavy quantitative finance. How does that model actually translate to what we're seeing on the trading floor?
Well, in quantitative finance, the Markov approach analyzes how markets shift between different underlying regimes or states. Think of a growth regime characterized by low volatility and steady returns versus a crisis regime defined by high volatility and rapid sell-offs.
Okay.
The Tehran data shows that when an international political shock hits, the market instantaneously switches into a crisis regime. That results in deeply negative immediate reactions.
Which makes sense, pure panic.
Exactly. However, the model also reveals that markets have a built-in mechanism for digesting fear. Once the initial shock is priced in, the market evaluates the actual structural damage.
So if the foundation is still there,
If the broader economic foundation remains intact, the market often switches back to a stable regime much faster than human emotion would suggest.
which means the initial drop is driven by the unknown and the recovery is driven by measuring the actual damage.
Precise.
That leads us directly to the million-dollar question for the global economy. How long does this last? The projections from Allianz Research and Oxford Economics emphasize that the duration of this war dictates absolutely everything about the economic fallout.
Duration is the single most important metric.
They map out 3 distinct timelines. Let's start with a baseline scenario of 1 to 4 weeks.
The sources assign this short-term timeline the highest probability. The analysis points heavily to the U.S. administration's domestic political incentives.
Because higher gas prices exacerbate the existing affordability crisis.
Right, which could severely impact the incumbent administration's prospects in the upcoming November midterm elections. The incentive for a rapid resolution is massive.
And Oxford Economics explicitly outlines their assessment that Iran cannot win a protracted conventional conflict against this coalition.
Leading to their prediction of a 1 to 3 week active phase. In this baseline scenario, oil leaks around $85 a barrel, but normalizes to roughly $70 by the end of 2026.
Leaving global inflation largely unaffected. Okay, let's unpack this a bit more. The baseline assumes a very clean, rapid resolution. But looking at the history of Middle Eastern conflicts, they rarely wrap up neatly according to U.S. political calendars.
That is very true.
Let's look at the medium probability scenario. What happens to the global macro picture if this lasts for months and the Strait of Hormuz remains contested?
A prolonged conflict fundamentally alters the math. If the strait is blocked or severely restricted for an extended period, Brent crude easily pushes past the $100 mark.
And DNY's research provides a critical rule of thumb for this exact situation.
Yes, for every $10 per barrel increase in the price of oil, if sustained for up to a year, global GDP growth suffers a 10 to 20 basis point reduction.
Now, the U.S. is slightly more insulated from that specific GDP hit because of massive domestic shale production, losing closer to 3 to 5 basis points of growth per $10 increase.
But the inflation effect is universal. A sustained $100 barrel of oil adds about half a percentage point to global inflation.
That puts central banks in a terrible position. They can't cut interest rates to stimulate the economy because they have to fight the oil-driven inflation.
Which means consumer borrowing costs stay high.
Then we have to examine the tail risk. This is the low probability worst-case timeline involving a long, sustained escalation where critical energy infrastructure, refineries, pipelines, terminals is physically destroyed, not just temporarily blocked.
Under those conditions, the sources project Brent crude rising above $130 a barrel, driving global inflation up by over a full percentage point.
And the knock-on effects in the bond market under that tail risk scenario are severe. The reports indicate the U.S. 10-year Treasury yield would likely hit 5.0%.
Combining $130 oil with a 5.0% 10-year yield creates a toxic environment for institutional portfolios. Term premiums rebuild rapidly.
Meaning investors demand significantly higher compensation for the risk of holding long-term debt in an inflationary environment.
All right, let's translate that for a second. Normally, government bonds act as the safety net in a portfolio. When stocks fall, bonds usually rise or hold steady, offering protection.
But in this tail risk scenario, because inflation is spiking out of control from $130 oil, those nominal bonds lose their hedging properties.
The safety net essentially catches fire at the exact moment the stock market is plummeting.
The result of those combined forces, crushed equities, and useless bond hedges is a projected 20% drop in global equity markets. It becomes a direct trigger for a global recession.
So duration and the physical integrity of the oil infrastructure are the variables that matter most.
That brings us to the political objectives outlined in our sources. The stated goal from the U.S. side is facilitating a change to a pragmatic ruler in Iran. So what does this U.S. win actually mean for the long-term economic map of the Middle East?
Alliance research provides 3 historical parallels to frame the potential outcomes for Iran's leadership and the subsequent economic ramifications. The first outcome is that the regime mutates.
Mutates how?
They liken this to the political transition in Spain following the Franco era, a gradual shift toward a more liberalized, pragmatic government driven by the desire for economic integration.
Economically, a Spain-style transition would be the ultimate long-term bull case. It would eventually lead to the unwinding of decades of sanctions, allowing Iran to fully reintegrate into the global financial system.
And more importantly for the global market, it would mean a massive, permanent stabilization of Middle Eastern oil flows.
But there's a flip side to that.
The second scenario offers a much darker parallel. The regime falls completely, resulting in a power vacuum. Alliance compares this to Iraq or Syria.
We saw the economic and geopolitical fallout of this in Iraq in 2003. A sudden collapse of the state apparatus leads to widespread insurgency and civil war.
That instability inevitably bleeds across borders, threatening neighboring infrastructure and creating decades of regional volatility. Global markets would be forced to constantly price a high geopolitical risk premium into oil for a generation.
The third scenario outlined is that the regime continues, essentially maintaining the status quo, but a diplomatic deal is struck to de-escalate the immediate military conflict.
Now, while we are analyzing these geopolitical dominoes, we have to address the China factor.
Yes. There is a lot of chatter and speculation about what happens if China enters this war. But looking closely at the intelligence and financial reports in our stack, that is a phantom scenario.
Completely.
The sources make it explicitly clear that China is not projected to enter this conflict militarily.
China is fundamentally a consumer in this dynamic, not a physical combatant. They've issued diplomatic warnings that the war could spread regionally, but their deep concern is rooted entirely in their economic vulnerability.
The energy math is staggering. China is the destination for 80% of Iran's oil exports.
That reliance is their Achilles heel in this conflict. If Iran's oil is taken offline long-term, either through a sustained U.S. blockade or infrastructure destruction, it creates a massive LNG and crude oil supply shock, specifically targeted at Asia.
Because China's vast industrial engine requires continuous massive energy inputs.
A disruption of that magnitude would force them to scramble for alternative, more expensive energy sources, significantly dragging down Chinese economic growth.
And because of their central role in global manufacturing and trade, a slowdown in China inherently drags down global economic growth.
This broad economic impact occurs entirely independently of any military involvement on Beijing's part.
The interconnectedness is incredible. So knowing the mechanics of these shocks, the varying timelines, and the broader geopolitical stakes, how is the financial world actually positioning itself? Here's where it gets really interesting.
RBC Wealth Management analyzed 20 post-WWII military conflicts to determine how the S&P 500 behaves during the outbreak of war.
The historical data provides a powerful counter-narrative to the initial panic. On average, across those 20 major military interventions, the S&P 500 drops an average of only 6% from the initial market reaction down to the trough.
Even more revealing is the recovery timeline. It takes an average of just 28 days for the market to fully retrace its losses and recover to the level it was at prior to the event.
The market is fundamentally unsentimental. It prices in the geopolitical fear in under a month, digests the structural realities using that Markov switching framework we discussed earlier, and then goes right back to evaluating corporate earnings and central bank policy.
28 days is a remarkably short window for an event of this magnitude.
It demonstrates the immense capacity of global markets to absorb geopolitical shocks without suffering lasting structural damage. However, and this is a big however,
The RBC study highlights one massive, glaring exception to this rule of rapid recovery.
the oil exception.
The data points specifically to the 1973 Yom Kippur War, which triggered the Arab oil embargo, and the 1990 invasion of Kuwait.
In both of those historical instances, the stock market experienced severe drops of around 16%, and the recovery took significantly longer.
The distinguishing factor wasn't the scale of the military conflict. It was the fact that the conflicts triggered a sustained, severe oil shock.
As long as crude stays below that $90 threshold we modeled earlier, the broader market can absorb the geopolitical hit. But if energy prices stay elevated for an extended period, the historical playbook says all bets are off.
Knowing this, we can see exactly where institutional money is moving right now to protect against that specific risk. The sources highlight some very clear sector winners.
Defense stocks and drone manufacturers are obviously surging. Gold is performing its traditional role as a safe haven asset, but there is a fascinating, almost counterintuitive rotation happening simultaneously. Megacap tech.
We are seeing massive capital inflows into companies like NVIDIA and Microsoft, which are effectively acting as safe havens in the midst of a Middle Eastern war.
Normally, when missiles are flying, investors rotate into gold bars, consumer staples, and utility companies. Now they're buying AI microchips. It is a completely bizarre rotation on the surface.
Under the surface, though, it makes perfect structural sense. It comes down to balance sheet fortresses.
Ah.
During periods of extreme geopolitical stress and fears over market liquidity, institutional investors mandate a rotation into companies that are cash-rich, carry low debt, and possess incredibly durable, high-margin earnings streams.
Megacap tech fits that criteria better than almost any traditional defensive sector right now. The market isn't buying them for their AI growth potential in this specific moment. They are buying them for their fortress-like balance sheets.
Speaking of fortresses, one of our sources provided a deep dive into a specific exchange-traded fund that illustrates textbook defensive positioning.
The Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. This fund tracks the Dow Jones U.S. Dividend 100 Index and is heavily utilized by investors seeking income stability. It currently boasts a dividend yield of around 3.37%.
Analyzing the underlying holdings of SCHD provides a masterclass in how institutional indices naturally align with the current crisis environment.
The top holdings map almost perfectly to the macro risks we've discussed. The number one holding, representing a 4.39% weight in the fund, is Lockheed Martin,
An aerospace and defense behemoth. As global defense spending inevitably ramps up in response to the destabilization, Lockheed captures that capital flow directly.
We reviewed the S&P Global Index methodology for these types of dividend funds, and it's worth noting they actively screen out companies involved in highly controversial weapons like cluster munitions.
However, broad defense contractors building advanced aviation and missile defense systems, like Lockheed, pass those screens and serve as massive components of defensive dividend portfolios.
Then we look at the energy exposure. Chevron holds a 4.13% weight, and ConocoPhillips is right behind it at 4.90%.
In both our baseline and prolonged conflict scenarios, upstream energy companies, specifically those producing massive volumes outside the contested Persian Gulf, are the principal beneficiaries of the volatility.
They capture the immediate upside leverage of the spot price spikes without carrying the localized geographic risk of Middle Eastern production.
The rest of the fund's top tier is rounded out by massive healthcare conglomerates like Bristol-Myers Squibb and Merck, alongside classic consumer staples like Coca-Cola.
It is a stark contrast to the highly speculative, macro-exposed sectors. Airlines, for example, are getting crushed from multiple angles: skyrocketing jet fuel costs, operational disruptions from closed airspace, and plummeting international travel demand.
Institutional money is fleeing those vulnerable sectors and anchoring in cash flow, reliable dividends, non-Gulf energy, and defense.
It is the practical application of pricing in the tail risk. You build a portfolio that can withstand the inflation shock of the oil exception, while maintaining exposure to the equities that will lead the recovery once the 28-day historical digestion period concludes.
Exactly.
We have covered an immense amount of ground today, from the mechanics of maritime insurance to the historical parallels of regime change. Let's summarize the core takeaways for you listening right now. The initial shock of this 2026 conflict is severe, and the daily headlines will continue to reflect that volatility.
But the macroeconomic data tells a very consistent story. Historically, financial markets are remarkably resilient to geopolitical events, often recovering within a month.
The caveat, however, is everything. The markets are resilient unless there is a sustained structural disruption to the global oil supply.
Your focus, as an observer of the economy, shouldn't be on the daily tactical movements, but on two core metrics: the physical navigability of the Strait of Hormuz and the overall duration of the conflict.
If the baseline scenario holds and it resolves within a month, The global economy digests the fear and moves forward.
If it drags into the medium or tail risk timelines, with oil sustaining well over $100, we face a serious, persistent drag on global GDP and a highly problematic resurgence of inflation.
Watch the duration and watch the oil.
And watch the long-term infrastructure grid.
What do you mean by that?
Well, we have spent this entire discussion focusing on the immediate spot price of a barrel of crude. But there is a much bigger legacy at play here. Consider the historical precedent of 2022.
The conflict in Ukraine.
Yes. When the conflict in Ukraine began, Europe didn't just pay higher spot prices for natural gas for a few months. The shock forced them to permanently structurally shift their entire energy grid away from Russian dependence.
They accelerated capital into new infrastructure because they realized they could never rely on that specific supply chain again.
This 2026 war raises the exact same structural question for the Middle East. Regardless of how quickly this specific military operation resolves, will this be the catalyst that forces the global economy to aggressively accelerate trillions of dollars into alternative energy grids, domestic production, and non-Middle Eastern LNG terminals?
So they don't have to rely on the strait.
Exactly. The ultimate economic impact might not be a temporary spike in oil, but a permanent global effort to ensure that this vital 20% choke point can never hold the world economy hostage again.
That structural shift could redefine the flow of global capital for the next decade. Thank you so much for joining us on this deep dive. It is a heavy, complex topic, but understanding the mechanics behind the headlines is the single best way to navigate the uncertainty. Keep asking questions, keep looking at the data, and most importantly, stay curious. We will catch you on the next deep dive.